today we're going to be presenting you Holt Challenge Renault versus Stellantis. So the car industry is changing fast with electric cars and smart tech growing. The market could reach $6.67 trillion by 2032. Asia and Europe lead in market share. Renault focuses on affordable electric cars. It's making more money again, but has reduced its assets to be more efficient. Stellantis is doing very well. It earns strong profits and runs many brands while keeping costs low. Renault TSR was flat for years, mostly because returns were just below the cost of capital. But since 2020, CFROI has started improving again. Assets growth was weak, especially in 2022, but signs of recovery in CFROI suggest shareholder returns could rise soon. Sales were bumpy with strong rebounds after the 2020 drop. Margins are stable and improving, showing good cost control. Asset turns are slightly down, but the company is becoming more efficient. Overall, Renault shows signs of smart turnaround. Stellantis had strong TSR growth, helped by big mergers that boosted assets growth in CFROI, but the latest data shows CFROI flattering and TSR starting to dip. That may suggest its strong run is slowing down. Margins peaked in 2023 but are expected to fall in 2024. Sales dropped by 80% and assets turns fell too. This could hurt TSR if not reversed. Compared to Renault, Stellantis now faces more pressure to maintain performance. Let's start with the flex valuation of Renault. In our base case, Renault stock could go up by 147%, but we took a more careful view and expect a 39% upside. The company is moving from a fast growth phase to a more mature market, especially in electrical vehicles. Sales growth is expected to slow from nearly 30% in 2023 to under 5% by 2029, and that's because of more competition and saturation in key markets. Margins and asset efficiency also shows it's harder to stay profitable in the environment. We've used a discount rate of 9.84% to reflect the extra risk Renault faces, but we still see good long-term potential. Now for Stellantis, in our main case, we see 87% upside, and under more conservative assumptions, about 52%. 2024 was tough. Sales dropped by 70% because of delays in new models and weaker demand in North America, but the company is expected to bounce back slowly. It's improving margins by cutting costs and refinancing its EV offering, and it also benefits from the merger between PSA. However, growth is expected to stay slow, and we raised the discount rate to 8.7% to reflect the recent uncertainty. To sum up, Stellantis is more stable with a smoother recovery, but Renault, while riskier, offers more potential upside. As risk-tolerant investors, we believe Renault long-term gains are worth the risk.